Happy Monday, everybody. I hope you had a great weekend. Strange to say, it was somewhat quiet on the news front. Maybe we're slowing down. I wouldn't expect it, but we'll see. When I say somewhat quiet, these days, quiet includes major airstrikes on the Houthis, a legal ruling after legal ruling in regard to Doge and jobs, as well as other executive orders. Isn't it a bit odd that we can call that quiet? So let's jump in. Today is March 17th, 2025, and this, of course, is your Monday market update. Let's review last week, and there was a lot, and then we'll preview this week. Also a lot on deck. Overall, last week was characterized by heightened volatility driven by trade war escalations, policy uncertainty, and mixed economic data. The S&P 500 experienced significant swings with a steep sell-off early in the week before a slight recovery attempt later in the week, and a big move up into the weekend. We'll get to all that. Monday started off the week on the wrong foot for the bulls. Recession fears resurfaced following President Trump's interview, where he did not rule out the possibility of an economic downturn due to tariff policies and government spending cuts. Just to be clear, it seems that the press is taking the Fed playbook to the White House. Not only do we need to watch what he says, but we also want to watch what he doesn't say. The New York Fed survey of consumer expectations showed rising concerns about the labor market and credit conditions, exacerbated market anxieties. The market suffered a steep decline, with the S&P 500 dropping its largest one-day drop since 2022. The Dow Jones was down over 2%, the S&P down over about 2.75%, and the Nasdaq was down almost 3.25%. A lot of damage is being done to this market. More than 4 out of 5, or 82+% of all shares traded on the Nasdaq stock market on Monday fell in price, while only 17% went up, according to FactSet. The rest were unchanged. The New York Stock Exchange fared a little bit better, with about 76+% of total volume declining and 22+% advancing. Those numbers correspond roughly with the number of declining versus advancing stocks on both the Nasdaq and the New York Stock Exchange. Decliners beat advancers by about 4-1. New 52-week lows on the Nasdaq reached 413 against just 69 new highs, while on the New York Stock Exchange, lows beat new highs at 137 to 42. Trading volume was active on Monday, with New York Stock Exchange composite volume of 6.5 billion shares. That's topping 125% of the past 30 days average, and NASDAQ composite volume of 8.79 billion, more than 106% of the past month's average. So again, this is FactSet data. It does make a difference, is what we're seeing here. As of Monday's close, 366 components of the S&P 500, or about 73% of the benchmark, were trading 10% or more below their 52-week highs. 203 companies, or 41% of the S&P, closed more than 20% below their 52-week highs. Also, as of Monday, 5 out of 11 sectors were trading 10% or more off of their 52-week highs. Now, these 5 sectors include consumer discretionary, technology, consumer services, materials, and, of course, energy. And for those keeping score of the Mag 7, they lost $750 billion in market value between them. Markets attempted to stabilize on Tuesday, but ended the day down down a little bit, hitting fresh multi-month lows. President Trump announced a 50% tariff increase on Canadian industrial metals, escalating trade tensions. A strong JOLTS job report was overshadowed by trade fears. Stocks attempted a midday rally on geopolitical relief as Ukraine signaled a potential ceasefire, but tariff policy uncertainty erased gains by the end of the day. The Dow was down almost 1.25%. The S&P down 0.75%. The Nasdaq was down just under 1%. Markets did show some resilience on Wednesday as it reacted to the cooler than expected CPI data, but trade tensions and geopolitical risks kept investors cautious. Key drivers of the market move: the eco data reinforced the narrative that the inflation continues to cool, boosting expectations that the Federal Reserve may cut rates later this year. Investors initially reacted positively, leading to that early rally. Market optimism was tempered by trade concerns, particularly after Canada announced over $20 billion in retaliatory tariffs on U.S. goods in response to recent U.S. trade measures. Bank of Canada expressed concerns about elevated uncertainty due to escalating trade tensions, adding to global economic worries. The S&P 500's early gains were wiped out mid-morning as investors digested all these risks, and added to the news, geopolitical developments created more uncertainty when Russian President Vladimir Putin made headlines by suggesting he was open to a ceasefire in Ukraine, but only to his terms, which cast a lot of doubt on near-term resolution. Markets initially reacted negatively as uncertainty surrounding the conflict and its economic implications continued to weigh on sentiment. There was a strong demand in that 10-year Treasury auction, and yields fell slightly. This provided some stability to the equity markets in the afternoon. JP Morgan CEO Jamie Dimon made cautious remarks about the economy, warning that ongoing uncertainty surrounding trade policy, inflation, and interest rates could weigh on future growth. His comments triggered late day selling as investors took a more cautious stance heading into Thursday. Now, just to refresh your memories, please recall that this is the same Jamie Dimon that forecast the economic hurricane a few hundred or more S&P points ago. Like any good weatherman, seems that if you put it out there and wait long enough, it just may happen. On Thursday, policy chaos took center stage, and with Treasury and Commerce secretaries giving unsettling interviews that reinforced fears of an incoherent trade policy, despite another favorable inflation report, the PPI, and strong jobless claims, that policy uncertainty and new tariff threats dominated the market narrative, pushing investors into risk-off mode. Markets seem to ignore the eco data and stay focused on the shiny object, that's the tariffs. President Trump did threaten a massive 200% tariff on European alcohol imports. That is in response to rumors that the EU was considering tariffs on American alcohol. This ramped up fears for a full-scale trade war, with Europe adding to the already significant uncertainty surrounding U.S. trade policy. Investors did sell off stocks aggressively as fears grew that this new trade fight could hurt corporate earnings, global growth, and investor sentiment. Midday, the market briefly attempted a rebound after reports suggested that Russia and Ukraine had agreed to a ceasefire in principle. However, late clarifications revealed that the two sides remained pretty far apart in key terms, causing stocks to fade their early afternoon gains and resume their decline into the close. Technology and consumer discretion were the worst performing sectors as investors rotated out of high growth stocks. Defensive sectors like utilities and healthcare outperformed but still closed lower. Energy declined as oil prices continue to struggle amid concerns about oversupply and weakening global demand. By the end of the day, Thursday, the S&P 500 was now down 10% from its February 19th high, marking an official correction. Investor sentiment remains fragile as trade policy uncertainty continues to overshadow positive economic data. The market's watching for further clarity on trade policy and whether the Fed will acknowledge the impact of these uncertainties in its next policy meeting. Overall, inflation data remains favorable, supporting the case for rate cuts later this year. However, trade war uncertainty, geopolitical tensions, and a weak market confidence are outweighing the economic positives. Until there's clarity on U.S. trade policy, markets will likely remain under pressure. The Dow Jones was down 1.25%, S&P down 1.33%, and the Nasdaq was down almost 1.2%. Then Friday came along. Stocks opened higher on Friday. At the open, the Dow was up 0.5%, S&P up almost 1%, the Nasdaq up 1.5%. Big question on everyone's mind, is the selling over? Will this bounce last? I love the research notes these days, absolutely all over. From don't expect volatility to let up anytime soon to this other house doesn't see any upcoming bear market on the horizon. The biggest one I saw was from a longtime prognosticator that the answers loosely to his newsletter subscribers. Bubble bursting this year. Some stocks will lose 99% of their value. Just to be clear, there are way more market calls than I can report on, but this one, like any in the business, they love to point out their right calls, but ignore the wrong ones over history. I'm not sure what this market will bring, but if you're looking for opinions, there's no shortage of them out there. In the rally on Friday, every one of the 11 sectors were positive. Some of the biggest losers for the week had good days. Eco data was more of the same. Consumer confidence from the University of Michigan dropped again, lower than expected, but maybe the level surprised, but not the direction. By the end of the day, the Dow was up 1.2%, S&P up almost 2.25%, the Nasdaq up over 2.5%. This was greeted with open arms, but it was not enough to offset the week. For the week, the Dow was down over 3%, the worst week since March of 2023. The S&P and the Nasdaq were both down about 2%. Now, let's turn the page on that. What's coming up? I'd say we have a big week, and that's not even including news out of Washington. Leading off today, we've got retail sales. And as you've heard me say, 70% of the economy is the consumer, and the retail sales do matter. It was a bit lighter than expected. Bad news or good news? We're going to see. Was bad news good news or good news bad news? We'll get some housing data this week, but I think it will not be in the news as the Fed enters a two-day meeting tomorrow and then announces and the announcements and the press conference on Wednesday. While you wait for Powell and the Fed to come out with their news on Wednesday, Tuesday afternoon we'll put Jensen Huang and NVIDIA square in the news again with this GTC conference. Fun fact, by the way, I found out two of the biggest names in semis these days, Jensen Huang and Lisa Su from AMD, they're first cousins once removed. Go figure, all in the family. After that, and the Fed, we'll get jobs data again on Thursday and some earnings from big names like Nike and FedEx. I've not seen the list of Fed heads speaking, but they will be let loose from the blackout period on Friday, so I imagine we'll hear from some. So I think that's enough for this week. As market volatility continues, please keep in touch. Keep your long-term goals in mind. When we talk, this is what we want to discuss. Day to day, you really can't make this up. So let's keep our plan front and center and focus on chasing success. Have a great week, and please come back on Friday for some updated planning ideas.